Michael Burry just dropped a bombshell prediction. The world is about to head back to the 1970s.
A statewide jobless rate of 9.3% has jammed local unemployment offices.
It was announced today that gasless Sundays will go into effect as of next month.
I think it's going to end with everybody changing their habits and going back to the things that maybe our parents were used to that we have never seen before.
Almost 1,000 of them showed up at City Hall in Sunny Daisy today, lined up from one end of the hall to the other. They were all there in response to a help wanted ad.
The 1970s was a terrifying decade to live in. The stock market was in complete turmoil. It halved within a matter of 20 months. Unemployment was skyrocketing. And while that was happening, prices were rising at unprecedented rates. But worst of all of these issues remained for an entire decade. That's a frightening reality to live in, and Burry thinks that we're taking a trip back in time. Everyone knows that history repeats itself because human behavior never changes. Having studied the 1970s extensively, Burry is confident that several critical patterns in the 70s will occur once again. You see, inflation has begun to decelerate to 6.5% year over year in the latest month. And because of that, everyone thinks that inflation will begin to fade away as we enter a recession.
At today's meeting, the committee raised the target range for the federal funds rate by 25 basis points, bringing the target range to 4.5 to 4.75%.
The decision was widely expected by economists, and it's a step down from recent increases, since inflation is starting to slow and the Fed has decided it doesn't need to be as aggressive.
People will say that once prices begin to drop and the economy recovers, we will recover from our economic crisis. But Burry knows something that many others don't know. Burry questioned, what strategy will pull us out of this real recession? What forces would pull us so? There are none. So we are really looking at an extended multi-year recession. Who is predicting this? There are none. But what does Burry mean by a multi-year recession? The term may seem foreign because the COVID recession was one of the shortest recessions in history. Behind the finance terminology, Burry's thesis is actually quite simple. Think of the economy as a bathtub. Everyone wants to understand the level of economic activity and how fast the economy is growing or shrinking. In the analogy of a bathtub, the water level represents the current level of the economy. If the water level is near the top of the bathtub, that would be considered robust economic activity. And if the water level is at the bottom of the tub, that would be a recession or depression. We ideally want to see the water between the middle to the top of the bathtub. The pandemic caused the water level to enter the bottom territory of the tub. The Federal Reserve pumped so much water into the tub that the water overflowed and spilled all over the restroom. To compensate for this disaster, the Fed is now sucking water out of the bathtub, causing the water level to reach the bottom of the tub. This makes perfect sense in theory, but the Fed forgot about the water that spilled all over the restroom. All the water that's on the floor represents a hidden danger that nobody is thinking about: money velocity. If you were to put that water on the floor back into the bathtub, then the bathtub would be full and spill once again. Burry explained how velocity is nominal GDP over money supply, M2 here. Quantitative tightening plus higher rates starting to push M2 down. Yet we are seeing a tick up in velocity, emerging from narrative obscurity. In 1978 to 79, rising velocity trumped falling money supply to drive inflation higher and higher. Redux would shock. So let's think about this in terms of the bathtub analogy. Even though the Fed is sucking water out of the tub, the water on the floor is going to fill the tub at a rate much faster than the Fed is taking water out. This will cause the tub to be filled up once again. But what exactly is the velocity of money? The velocity of money represents the rate at which each dollar is spent on goods and services. Everyone is sitting on their cash right now because people know that we're in a recession. If prices were to finally start dropping at rapid rates, people will start buying products once again. This would cause the velocity of money to go up because the dollar is being transacted more often. There's a terrifying dilemma occurring in that scenario. If prices were to drop and the velocity of money were to increase, then prices would start accelerating again. This would lead to a second wave of inflation caused by the velocity of money. Such an occurrence happened in the 1970s. Even though the money supply was being shrunk by the Fed, the velocity of money was increasing so fast that inflation accelerated again to over 14%.
Prices went up infamously during the Carter presidency.
Inflation was increasing and unemployment was increasing at the same time. That wasn't supposed to happen.
All these people stood in line today and filled out applications at Chattanooga's Employment Security Office. They were responding to this ad posted in yesterday's and today's local newspapers.
Carpet is a luxury during hard times. That's one explanation given by employers forced to lay off workers because of drooping carpet sales.
The jobs are taken, and this is a new opening. Everybody needs a job. Just no jobs. Not here in Chattanooga, I guess. No jobs here.
Another event that will make Burry's thesis even more frightening is the idea that the Fed will suddenly start printing money again. Burry believes that from June to December of 2023, inflation will likely start decelerating to levels that may even be negative. This will be due to rising interest rates from the Federal Reserve. The issue is that the velocity of money likely won't start accelerating until 2024. So before the velocity of money picks up, the Fed and the fiscal government will start printing money again. This will lead to the start of the next spike in inflation, just like we experienced in the late 1970s.
Specifically, Burns said he opposes continuing the 1975 temporary income tax cuts, which now put more money in every worker's paycheck. Burns also said most of today's jobless are voluntarily unemployed, explaining that because of unemployment insurance, they're not forced to take the first job that comes along, but can wait for a better one. As a result, he said, the newspapers are full of help-wanted ads and farmers can't get workers to pick their fruit.
Burry explained how inflation peaked, but it is not the last peak of this cycle. We are likely to see CPI lower, possibly negative in 2H 2023, and the US in recession by any definition. Fed will cut and the government will stimulate, and we will have another inflation spike. It's not hard. So not only do we have the mess that the overflowed bathtub created on the floor, but we also have the Fed pumping even more water into the tub. Both of these activities are only going to overflow the bathtub once again. The bathtub might even be filled up to an even larger degree than last time. Such an event already happened in the 70s and 80s and will inevitably happen once again. Some investors might think that the Fed isn't that dumb and has our best interests in mind. But Burry knows that's not true given their sketchy track record. Michael Burry accused the Fed of purposefully selling all of their stocks at the top of the bubble in the fall of 2021. Follow the Fed? Never forget the fall of 2021, when Fed governors suddenly decided, in a Nostradamus move, that it was unethical for they themselves to hold and to trade in stocks. While our current situation is similar to the 1970s, there are also many parallels between now and the dot-com bubble. The number of similarities between the dot-com bubble and right now are shocking.
This closing bell might as well have been an alarm, so savage was the selling. In percentage terms, it had less impact than the crash of '87. The plunge was sparked by a jump in US inflation, the fear a bigger hike in interest rates the only remedy.
And so, as the stock price was going the wrong way, everything inside the company was going the right way.
Internet giant Yahoo is worth more on paper than the total value of Kmart, Hilton Hotels, and Delta Airlines combined.
In the year 1999, there were 457 IPOs. Most of which were internet and technology related. In 2001, the number of IPOs dwindled to 76.
Just like the dot-com bubble, we had a mass amount of IPOs in 2021. We also had bubble crypto coins that had no function other than making money, which was just like the internet stocks with no fundamentals. And lastly, we had a high volume of fraudulent schemes that were just like Enron, WorldCom, and many others in the dot-com bubble. Now that the recession has sunk in, the fraudsters have been exposed and the bubble coins are now in the dumpster. But the crash is far from over, because some people still insist on buying the dip in bubble stocks and coins. Burry explained how in early 2002, investors were asking me why I wasn't buying WorldCom. Feels like that right now. WorldCom is one of the largest accounting frauds from the dot-com bubble. The scandal came to light in the summer of 2002. Many investors wanted to purchase the dip on WorldCom prior to the company being exposed. You see, businesses like WorldCom still exist today, but they just haven't been exposed yet. So with all that being said, Burry doesn't think that the crash is over yet. He tweeted, "Maybe," with a petrifying graph attached. The graph had a circle around late 2001 before the market crashed even more. This indicates that Burry believes that we will have a 25 to 35% further drop in the market. So given everything we covered in this video, you might be wondering how an investor like Burry is not only protecting his portfolio, but also profiting from this upcoming trend.
So you made a ton of money?
Made a ton of money. Much more than I ever imagined, I'd ever have. Well, we had a giant bet
for us, and I was extremely confident in the outcome.
Contrary to what you might be thinking, Burry isn't shorting the market right now. This is because inflation has already peaked in the short term, and that's a bullish sign for the market right now. Burry tweeted, "I am not short. Well, I've been 6 feet for a while. May get to 1.7 meters in time." These tweets are obviously not in reference to Burry's height. Burry's real height is actually 5'7", or 1.7 meters. He is referring to the fact that he is actually quite tall right now. In other words, he has more long positions than short positions. So instead of shorting the market, Burry is purchasing assets that would perform well in this environment. We're currently dealing with economic contraction and inflation simultaneously. In times like this, gold is a protective asset against currencies like the dollar. Many investors saw cryptocurrencies like Bitcoin as a store of value, and therefore a competitor for gold. But now that crypto is doing extremely poorly, Burry believes that gold will be a strong investment in the near future. He explained how he long thought that the time for gold would be when crypto scandals merge into contagion. Another asset that tends to do well in the current environment is companies that generate high amounts of cash flow. Burry has found 2 sectors with these cash cow companies, one of which is actually Hong Kong stocks. He tweeted, "As for me, I like Hong Kong." Many investors are scared of the Hong Kong market due to its ties to China, but Burry believes that behind the fog, there's actually a huge opportunity there. Most Hong Kong citizens are skeptical of the stock market because they see the market as a risky investment. So instead of investing in the market, Hong Kong citizens are more likely to invest in other assets like bonds and real estate. This has caused the Hong Kong stock market to be extremely undervalued in comparison to the US market, where investing in the market is encouraged. The Hong Kong economy is under substantial pressure due to COVID restrictions, but times are changing now. Hong Kong has been loosening its restrictions on mainland China and other countries, which has led many economists to become bullish on Hong Kong. A survey by Bloomberg showed that economists now see Hong Kong's economy growing by 3.3% rather than the previous forecast of 2.7%. This is happening while the Hong Kong stock market, or the Hang Seng, is down by a significant amount. Burry tweeted, "Meet the new boss, same as the old boss." The Hang Seng recently hit 1997 levels, 25 years, yet GDP multiplied 18 times during that time. 1997 valuations were 20 times earnings, 10 times EV to sales, 3 times tangible to book. Now 7, 1, and 1. Note, 3 of last 4 premiers served 3 terms. So instead of a 20 times price to earnings ratio in 1997, the Hang Seng is now trading at a 7 P/E ratio. And instead of a 10 times enterprise value to sales ratio, the Hang Seng is now at a 1 times EV to sales ratio. And instead of a 3 times price to book ratio, the Hang Seng is now at a 1 times price to book ratio. The fact that the Hang Seng's valuation ratios are trading at such low value suggests that the market is incredibly undervalued. But many of you may be skeptical of the Hong Kong market, which opens up the option of the US market.
News today, but even more fascinating than that is actually former hedge fund manager and the Big Short investor Michael Burry noted he sold all of his positions earlier this year except this one.
Protest is happening right now in front of the Geo Group in Boca Raton. According to a Facebook post from that group, Fort Lauderdale food not bombs.
In addition to Hong Kong stocks, Burry has been purchasing US stocks with high cash flow yields. A company's cash flow yield is calculated by taking its free cash flow and dividing it by the equity value. So this means that to achieve a high cash flow yield, a company can either have a low valuation, high cash flow, or both. Following the dot-com crash, these types of cash cows performed extremely well, and there's no reason to believe that the exact same thing won't happen right now. Burry actually believes that the buying opportunity for cash cows is even better now than in 2002. He explained how low price/cash flow businesses are different today versus 2000 because they will buy back stock, buy back debt at a discount, and in general manage capital structure better. Makes them better statistical values, math problems that more or less must work out. Burry further explained this thesis by saying, companies that are heavily leveraged but have the cash flow and termed out debt have options today, including reducing their debt loads at a significant discount brought on by higher rates. But as Graham said, in such a case, better off buying the stock. So Burry is essentially purchasing stocks that have the following 4 characteristics: high cash flow, low valuations, high debt, and a strong moat. Stocks with these characteristics will likely do incredibly well in a post-speculative environment. One example of this is Burry's largest holding, the Geo Group, which is a private prison facility. Although their business model is controversial, the company has the exact characteristics that Burry is looking for. The company generates massive amounts of cash flow, has a low valuation, a high debt-to-equity ratio, and a strong moat. The Geo Group currently makes up about 37% of Burry's portfolio. Do you agree with Burry's thesis and his investments? If you want to see more videos like this, please hit the like button and subscribe. And I'll see you in the next one.